I'm Michelle Cole, and I am licensed to do mortgage loans under license NMLS 248631, California Broker's License 004710003 throughout the state of California. And I am a reverse mortgage specialist with C2 Financial. Today I want to talk about retirement planning to fund your lifestyle and legacy. It's a 3-bucket strategy. And most importantly, I would ask, should a HECM, which is a home equity conversion mortgage, be part of your plan? So let's dive in and take a look. So in retirement planning, let's be honest, the overall mission is to make sure that your money lasts as long as you do. So what is the greatest fear among American homeowners, especially older folks heading towards retirement? It's the fear of running out of money before their life ends. And let's look at this honestly. I think most people would agree, no matter what they age, if we're thinking as we get older, what if I run out of money? Well, our job is to try and make sure that that doesn't happen. So beginning with bucket one. Bucket one is our income and cash. It's how we pay for our daily expenses. And of course, it supports our lifestyle and having some fun too. Then we have bucket two. Now this is our assets. That would be Social Security for the future, our different IRAs, investment accounts, brokerage, pension, savings, and all of these items at some point we want to tap into and use those funds. But there's also significant prohibitions from taking it out too early because, as we know, a lot of those are taxable. But all of these funds will require at some age that we start taking them out. And typically, on the right here, you see Social Security comes available between 62 and 70. Our pensions, 60 to 70. IRAs, 59 and a half. Our brokerage accounts, savings accounts, all of those funds become available at some time. And this is what we look towards funding our future lifestyle and our legacy. So we've got 2 buckets so far, the income and cash, our assets. And so what is that 3rd bucket? And what would it do for my retirement plan? That bucket's our home equity. Most of us own a home, and as a homeowner, the home expects to grow in value over time, and that we would have equity available in our home. How available is that? Well, our home equity is the difference between any mortgages we have on our home and the value of the property. In our early years, we watch the home grow in value, and a lot of us, of course, move that equity from one home to another. You may be doing that right now. So let's look really closely at this 3rd bucket, and that's our home equity. But let's look at it as a possibility of where we could draw for the future as a HECM, that's a home equity conversion mortgage or line of credit. So how do we use home equity? Well, some people decide that as they get older, rather than staying in the home, they'll sell it and pay taxes, which you will. You will pay a certain portion of capital gains to the government, of course, then maybe live on the rest, rent a home, buy a motorhome, travel across the country. So maybe that's your preferred lifestyle choice. Or a lot of people want to leave their home free and clear to the kids, pass that on when they die. And to be honest with you, a lot of kids really don't want the family home. They would like the money, but not necessarily the home. But most people grow up with an idea of a free and clear home is the best choice. And if you do that, that's possible, especially if you have other assets that you can draw from that are significant enough that you'll never need to tap into home equity, that you truly can have a free and clear home. But there are many, many people that really can't do that successfully without having to really scrimp for the rest of their lives and maybe not live a lifestyle in their retirement years that they really would like to. And they can become what we call house rich and cash poor. What other alternatives are there? Well, you could get a traditional mortgage or equity line on that home in your retirement years, but it's a little more difficult to do so to qualify when you're no longer working. And also, do you really want to make payments when you're in retirement? So what's the HECM, the home equity conversion mortgage? It is an FHA insured reverse mortgage, which provides a lump sum or line of credit, the LOC. It is also a non-recourse loan, which means that you can pay it off at any time. Also, you will never owe more on the home than what it's worth. And this is the bucket we want to focus on, that your home equity can become a source of cash for your future for all sorts of things that you may want to do. If it's just supplementing or if it's actually making regular payments to you, there's many options that you can tap into that line of credit. You have to be 62 years old, the youngest person on title. There's no required monthly principal and interest payments. And you do have to make the taxes, insurance, any property charges on it, and maintain the property. It has to be your primary residence. And there is a financial assessment and property eligibility requirements. Let's say for right now what we're looking at, that you would be able to qualify. Let's just assume that for the case of our presentation here. And any cash that comes out of a line of credit is tax-free. It's a loan, mortgage like any other, and it can become an alternative source of retirement funding. It also can be a hedge against market volatility, which we'll talk a little bit more in detail shortly. So we've got three buckets here: income and cash, assets, and your home equity as a home equity conversion mortgage line of credit. So we're going to talk about how money works. First of all, you've got a job, and from that job, you make income. And the income, of course, we put in the income and cash bucket. The assets, ideally, if you can take 15% of what you're earning and put it into the asset bucket, how good is that? So for the future, you're laying up, you're paying into Social Security, you've got maybe brokerage accounts, stocks, bonds, etc., your IRAs, savings, pensions growing, and then you have a home. Now 25 to 40% of your income is probably going to go towards your mortgage payments, so therefore your equity is growing as you pay down your loan. And of course, property, especially in California, is getting more and more expensive, meaning as you pay down your mortgage, you've got a lot more equity to work with. So income going into the cash and income bucket, money going into your asset bucket. And then, of course, we've got to address our silent partner here, the government that comes in that wants to take some of what you've worked hard for in the form of taxes. So the IRS is right there for their portion all along our lifeline here. And I like to say it's theirs. They think it's theirs. It belongs to them, a portion of what you're making. So for us, for most of us, we want to look, how can we minimize taxes over time? How do we want to reduce the hit that we have on what we worked so hard for? So as we said earlier, any money that you're taking out of your assets, if you're taking them out early, you're going to pay taxes. What if you have a home equity line of conversion and a line of credit that you've taken out when you're 62, and say there's market volatility, just like we've seen absolutely recently, where the stock market is going up and down, and in order to live, you really don't want to have to tap into savings. You may not want to reduce your regular income and cash bucket. What other alternative? Well, if you have a home equity conversion mortgage, HECM, that line of credit, you can take money out of it periodically instead of drawing down on your assets. So it's a wonderful source of alternative funding from the time that you get it. And then, of course, all of a sudden you're retired and your choices may be somewhat more limited. So it's even nicer to be able to have an alternative to hedge against market volatility and Another thing that of course we know is in the asset buckets, they are going up in value from 4 to 6% on average. Some will say that it goes up a lot higher, and that's true. Sometimes it does. But any money that's drawn out is usually taxable. And your equity in your home is probably going up at least 4 to 6% per year, if not a lot more. And also, if you have a home equity line of credit, you may want to know that that line of credit grows over time. In fact, it gives more money is accessible in the future. If you're not drawing it out, it's growing in value, and generally at least 4 to 6%. And it's all tax-free. So there comes a time that you're going to be drawing out of your assets. You're going to have what's called required minimum distribution. And at that time, when you draw that money out, a lot of it is going to be taxable. So what if there's another way that you can minimize that tax hit when you take the required minimum distributions? Now, there is what's called, when money comes out of your asset accounts, you get a 1099 and you would be paying taxes. What if you take a portion of that and pay down on your loan balance that's part of your line of credit and reduce that, which means that you actually will have more money available in your line of credit in the future. And also, the payments that you make on that loan balance may be eligible for a tax deduction. And the interest is deductible. You would get what's called a 1098. Some of you may have received that when you pay down on other interest. And in essence, it can reduce significantly the tax hit that you may get from taking your income distributions. So let's see how does the HECM line of credit really work. Here's a chart. This is a simulation based on a property that is worth $900,000, and the line of credit is based on the age of the youngest borrower and the value of the property as well as the interest rate. For our illustration, which is illustration only, your situation will be entirely different and unique to you. But for the case of showing you how this works, this particular illustration has an interest rate of 6%. And in the first year, the individual takes out $50,000 at close of escrow. On the line of credit, we see across the line, there's a loan balance of $77,000. The principal limit is what you're eligible for at the time that the loan is taken out, and that also grows over time. In this case, it's $315,900. We say that the property grows at 4% a year, maybe more, maybe less. And when we started, it was $900,000. So between the loan that was taken out, there's $822,712 left as equity. Now, what's really interesting here is let's look down at year 5. And at that time, this individual decided to take out $50,000 and use that for whatever expenses. You can use the money for whatever you want to. And look over here to where where it says LOC, and at the time the money was taken out, notice how the line of credit, when the money was taken out, the line of credit was $311,000, and the money was taken out, which reduced the line of credit to $283,000. A few years later, the individual decided, well, I'm going to pay into the line of credit. I've got some extra money. Maybe they took one of those required minimum distributions and they paid down the line of credit. So look over here under the LOC line and you see where there was more available now. It went from $302,000 up to $348,000. And as you see, if you look down that line, that over the years, the individual took out money and put some back in. And if you go clear over to the right under equity, you see how changes occurred based on when money went in and when it come out. Let's look at a summary here. This is what happened the last year And this person, if they took their loan out when they were 62, they would have been 90, well, actually, they would be 100. So that's possible. Did you know that actually a reverse mortgage has an end date? We say it's for as long as you live. Well, they actually put an end date on it, which is 150 years. Now, nobody's lived that long, so highly unlikely. But anyway, most loans are figured up to the age of 99. In this case, we've got it up to 100, but you'll notice across the line, and this was from 2025 up to 2063, and at that time, there was still a line of credit available at $2,095,000. There was a loan balance of $1.7 million. The property value was almost $4 million because it, of course, had risen over time, and there was still equity of $2.2 million in there. Now, one of the most important things to understand with a reverse mortgage is that at any time you wish, you can call the loan servicer and say, I would like a check for the balance in my line of credit. So in this case, maybe you are in your 90s and you go, I'm going to keep my home until I die, but I want to give money out to my kids, my grandkids at this point, at any period of time. And actually, no matter what the value of the property is, you can ask the loan servicer to give you a check for the balance in your line of credit. So in summary, this shows how property grows over time. What we were talking about in the previous slide, the property value in 2063 is almost $4 million, equity of 2.2, the growth rate at 4%, and a line of credit available at over $2 million. So this chart shows you where we've got pluses and minuses. Those are the distribution and plus the payments into the account. You'll see, looking at the chart over time, over the years, how the line of credit continues to grow. Even though money's coming in, some money's going out, the equity in the property continues to grow as the value grows. So with your home equity conversion mortgage line of credit, you've got a lot of options for your future to make sure that you can fund your lifestyle and your legacy and not run out of money before you pass from this life. Just want to thank you. Thank you for staying tuned for this on retirement planning to fund your lifestyle and legacy. And again, I'm Michelle Cole. I would love to hear from you. Give me a call or text, and my email's right here. I am with C2 Financial Corporation, and I have been in the reverse mortgage business since 2012. And before that, in 1989, I started my mortgage career. So I have a little experience, all in California, and I would love to hear from you. Thank you again. Have a great day.